we're going to go ahead and turn this over now to Joe and get started.
All right. Thank you, Amy. And welcome back to everybody who was here last week, and welcome to the new attendees. And in order to forestall any potential shutdowns like we had last week, we now have installed the technological equivalent of belt and suspenders. So we're ready to go here. So we will get started. As you've probably noticed, 2020 is a year like no other, and that's true for tax purposes also. And we're going to cover tax planning issues that are unique to 2020. Then we're going to cover standard tax planning and the 2020 twists that apply. So we'll get going here. What's unique to 2020? Well, just to start, we've got a nationwide disaster declaration and its consequences. We have special tax credits that came out of the CARES Act. We have Paycheck Protection Program loans, which are forgivable, but then which trigger non-deductibility unless Congress changes its mind, in which case it won't. We have special loss and deduction changes as a result of the CARES Act, including loss carrybacks, which had been not a thing since 2017, but are retroactively a thing to 2018. We have issues for recipients of unemployment benefits, and the IRS just yesterday reminded everybody that those are taxable. We have a lot of state tax filing issues. We have a lot of state conformity challenges where the feds have changed the rules in mid-year and the states haven't necessarily done so. And then looming over everything is the possibility of political changes in the upcoming election. And that could greatly affect the wisdom of a lot of conventional tax planning ideas. So let's keep moving on and address these. On March 13th, 2020, President Trump declared a nationwide emergency pursuant to Section 501B of the Stafford Act to avoid governors needing to request individual emergency declarations. That made the entire country a disaster area. That allowed the IRS to delay the April 15th filing deadlines to July 15th. It also triggered the ability of taxpayers nationwide to take an itemized deduction for casualty losses, quote, attributable to the COVID disaster. So it'd be a good time to review disaster loss basics. Business disaster losses are claimed on the tax return for the business. Straightforward. Non-business disaster losses are casualty losses deductible as itemized deductions. Business or personal losses may be deducted either on the tax return for the year preceding the disaster or in the year the disaster occurred. This election on which year to take your disaster loss deduction may be made as late as 6 months after the due date of the return for the disaster year. For 2020 disasters, that's an October 15th, 2021 election deadline for individual returns to choose whether you deduct those losses on 2020 or 2019 returns. The election to deduct in the prior year may be revoked within 90 days of making it. If you've already filed 2019 returns, they can be amended to claim 2020 disaster losses. And as of right now, assuming your software allows it, you can e-file a 2019 amended return. Then the next question is, how big of the loss? And here's from the IRS Disaster Resource Guide. First, you got to determine what your basis is before the casualty. You can't deduct a bigger loss than your basis. Then you need to determine the fair market value of the property and its decrease as a result of the casualty. You get to deduct the smaller of the decrease in the fair market value or your adjusted basis before the casualty. You have to reduce your deductible loss by any reimbursement you receive or expect to receive. The disaster loss regulations provide that a disaster must be evidenced by a closed and completed transactions and fixed and identifiable events. A mere decline in value is not necessarily dispositive. That means it's a fact-intensive process to determine your casualty loss. You need to be able to identify the portion of the loss attributable to the disaster. Now that's a real problem here with the COVID disaster. For disasters like Iowa had last week, 100-mile wind, trees falling down, crashing into houses, crushing cars, that's pretty easy to identify the portion of the loss attributable to the disaster. But what if, say, you own publicly traded stock and you decided to sell out right at the bottom of the market when everything crashed as a result of the COVID shutdowns? How much of that is attributable to the disaster? How much of that is attributable to you not being a particularly good market timer? That's something we really don't know because we've never had a nationwide disaster that could possibly apply to somehow to every transaction that's gone on in the last 6 months or so. So that's something that we're waiting. The IRS knows that this is a problem. They know that people are wondering to what extent they can take stock market losses as itemized deduction casualty losses. I think it's likely that guidance will come out, but I have no crystal ball and I haven't heard anything imminent. So with the October 15th deadline coming up for extended individual returns and extended C Corp returns, and the September 15th deadline coming up for pass-throughs, it's a hot issue. So watch things carefully and remember that you do have the ability to change your mind as a result of the October deadline of next year to determine which year to take your casualty loss. So when you're deciding which year to take your disaster loss, you need to decide, well, what's the best year to claim the loss? If you had a great 2019, maybe that's the year to claim the loss because you're in a higher bracket. Or maybe you had a crummy 2020 and it's so crummy that that disaster loss can generate a net operating loss. And maybe you'll be better off carrying that back to 2014, in which case you might be dealing with the pre-TCJA brackets of up to 39.6% for an individual return. So what year is the deduction worth more? Then, of course, you need to remember state treatment because that can tip the scales if you're right on the edge. All right, let's talk about the opportunities that the CARES Act, enacted in response to the COVID disaster, provide for us. We're going to emphasize 4 general areas of tax planning opportunities unique to the CARES Act. The business interest deduction liberalization for 2019 and 20. The retroactive waiving of the business loss allowance caps for individuals. The revived ability to carry back net or operating losses, and the retroactive real estate improvement depreciation relief provided in the CARES Act. The business interest deduction liberalization relates to so-called Section 163J, which was enacted in the Tax Cuts and Jobs Act as a revenue offset. That limited business interest deductions for effective taxpayers to 30% of adjusted business income or adjusted taxable income. That has been increased to 50% of adjusted business income for 2019 and 2020. If you've already filed a 2019 return that's affected by this, you may file an amended return, and as of this week, amended 1040s may be filed electronically. You think, well, that only affects taxpayers with over $25 million of gross receipts. Well, don't be quite so sure, because under the Section 163J limits, a tax shelter is also subject to these limits. Tax shelters include pass-throughs where more than 35% of the losses are allocable to passive owners. And a lot of people are having 2020 losses, so you need to keep an eye on that. You may be having a less of a loss than you think if suddenly the losses that you're incurring for 2020 turn out to be tax shelter losses. In 2017, then the excess business loss limitations also applied. The did apply, and they've been retroactively waived. The 2017 Tax Cuts and Jobs Act limited business losses to $250,000 for single filers and $500,000 on joint returns, and that's on top of existing loss limitations such as basis, at-risk, and passive losses. Excess losses are treated as net operating losses to be carried forward. This was originally effective with 2018 filings. Retroactively, that date is now for returns filed starting for 2021. This means taxpayers can amend 2018 returns and 2019 returns already filed to claim the losses limited by 461L, claim refunds, and possibly carry them back. A word of warning: if you want to carry back losses that are freed up as a result of amended 2018 or 2019 returns, you need to file the amended 2018 and 2019 returns before you carry those back. Otherwise, the IRS won't process it. That can be a problem if you're having to file a paper NOL carryback, which you still need to for 2018. We've run into that where the IRS is not processing carrybacks of 2018 losses claimed on Form 1045, the quickie refund form, because they hadn't processed the 2018 paper loss carryback because it's probably in a trailer stored outside the Ogden or Kansas City Service Center. So that's a good argument for making sure that if you are amending 2019 to increase your losses, make sure you file that amended return electronically so that you can file the 2019 quickie refund and not have it hung up by a paper processed 1040X for 2019. Of course, beware of state issues. Iowa has a very taxpayer unfriendly treatment of 2019 excess business losses. Iowa computes net operating losses separately, and therefore, if you have an excess business loss for 2019, which Iowa has not yet conformed to, unless Iowa changes its law, your Iowa 2019 excess business loss, which still can happen, will be lost forever. So watch out for state issues. Okay, some of you may remember the term retail glitch. This was something that arose in the 2017 Tax Cuts and Jobs Act, where they meant to make qualified improvement property subject to 15-year life instead of a 39-year depreciation life, and to make it subject to bonus depreciation. They put it in all the committee reports, but they failed to put it in the 2017 Tax Cuts and Jobs Act. So we had a problem for people with this. The CARES Act retroactively fixes this for property placed in service in 2018 and 2019. If your 2019 return is still out on extension, you can claim the 2018 depreciation on an amended return. Otherwise, you can claim it on your 2019 return via an automatic accounting method change. So either way, this could be a significant increase in your depreciation allowance for property placed in service in 2018. Remember that qualified improvement property generally includes interior, non-structural improvements to non-residential buildings placed in, and with improvements placed in service after the buildings were originally placed in service. Finally, net operating losses. The CARES Act allows 2018 and 2019 net operating losses to be carried back 5 years. Calendar year 2018 losses may be carried back by filing amended returns for the loss year. 2019 returns losses may be carried back via the quickie refund claim, Form 1045 for individuals, Form 1139 for corporations. As pre-2017 years generally had higher tax rates, carrybacks are often more valuable than carry-forwards at current rates. Now remember, not everyone wants to carry losses back. Taxpayers have the option to carry net operating losses forward. This election is made by filing an election statement no later than the filing of 2020 returns. Before carrying losses back, be sure to consider whether changes in the interest deduction limits, business loss limits, and qualified improvement to depreciation may affect the amount of losses that can be carried back for refunds. For qualified improvement property, you might want to consider obtaining a fixed asset study to maximize losses. The I-Bailey Fixed Asset Group would be a great place to go, and that's the commercial that we will have here. And finally, one last reminder, remember, if you are going to be amending a return for 2019 to carry back NOLs and you want to file a quickie refund, be sure to take advantage of the e-filing opportunity that's now available for amended 1040s for 2019. You want to have that processed before the IRS gets your quickie refund claim. Among the changes that apply for under the CARES Act are relaxation of a number of rules for qualified plan withdrawals. For specified eligible taxpayers only, you can pull money out of your plan and get penalties waived up to $100,000 of withdrawal, and you have 3 years to avoid tax entirely by putting the money back into the qualified plan. Eligible taxpayers are those who are diagnosed with the COVID virus, had a spouse diagnosed, or taxpayer who experiences adverse financial consequences as a result of being quarantined, being furloughed or laid off, or having worked hours reduced due to such virus or disease, being unable to work due to a lack of child care because of the virus, reduced hours of a business owned by the individual due to such virus or disease. So it's a pretty broad, but not quite universal waiver of penalties and special opportunity to, in effect, take an extended borrowing out. So key things: watch the $100,000 limit, make sure your taxpayer qualifies, and remind them that they can put that money in. And then finally, the advice that always goes to my clients who are pondering early qualified plan withdrawals: don't do it unless you really need the money. Another qualified plan spiff as a result of the COVID virus is a waiver of minimum distribution rules from qualified accounts for 2020. This is a very taxpayer-friendly thing, and I'm not quite sure what the logic is behind it. I guess maybe in all the confusion of the COVID virus, maybe people just aren't going to remember to make their RMDs. In any case, penalties are waived for 2020. What are some other specialized CARES Act issues? PPP forgiveness, loan forgiveness, is tax exempt. However, the Treasury has said that any of the expenses that enable you to have that loan forgiveness occur are non-deductible. So it sort of makes forgiveness sort of a tax nothing burger. There's bipartisan consensus that that should be deductible, but right now nothing is moving in Congress as far as any kind of CARES Act additional relief, and it would require an act of Congress to forgive those loans. So just watch closely there. It obviously will be affecting estimated tax payments, and unless they do something by September 15th, you'll need to assume non-deductibility to be safe. Remember that there's an employer retention credit that's potentially lucrative. 50% of the first $10,000 per employee in comp for businesses shut down or experiencing a 50% gross receipt decline over prior year. Both of these, both the comp limit and the gross receipt decline limit may be affected by pending legislation or may not. Also, remember the deferral of employer share of payroll taxes for 2020 with repayment required half by the end of 2021 and half by the end of 2022. Not all clients, in fact, many of my clients are not taking advantage of this deferral. And then on top of this, which I won't spend a lot of time on right now because it's so up in the air, is the announced deferral starting next month of employee share of payroll taxes for the rest of the year. Until Treasury guidance comes out saying on how this works, right now we're very much up in the air on what to do. Right now, it's simply a deferral, not a forgiveness, which would mean that a client who has full deferral will need to come up with an extra $2,000 of payroll taxes by next April 15th. Unless, of course, the employer is liable for that, in which case the employer is not going to be at all excited about allowing employees to defer payroll taxes. So all I can say about the employee side deferral payroll taxes is watch closely. We'll be covering it very closely on the Eide Bailly Insights website, the ebtaxblog.com. We'll be covering that obsessively. So watch ebtaxblog.com daily or subscribe to it, and you can get it in the convenience of your email mailbox. Now that we've covered the CARES Act specific tax planning, we're going to pivot over to 2020 so-called standard tax planning. First, we're going to do a refresher on estimated tax requirements. A lot of taxpayers get very confused on how estimated tax payments work. You tax pros on the call can take a quick nap here as I cover this. But remember, the typical individual estimated tax payment requirement is you have to pay the lesser of 90% of the current year tax or 100% of prior year tax in a combination of withholding or quarterly estimated tax payments. If your prior year adjusted gross income exceeded $150,000, then you need to pay 110% of prior year tax to meet that safe harbor rather than 100%. Corporations have similar requirements, but large corporations can only get by with the current year tax safe harbor after the first quarter of each year. Taxpayers with fluctuating income may use what's called annualization, paying quarterly taxes based on year-to-date results to minimize tax in early quarters. So as you're planning your estimates, you need to consider, are you better off based on prior year or are you better off based on current year? If you're expecting a big loss in the current year, then you want to go with the current year, but that means you need to know what that number is likely to be. If you have a forgivable PPP loan, that could be a big part of your deductions for the year. And so you don't really know what 90% of your current year is until that PPP loan forgiveness issue is settled. Since it is 2020, nothing works like it should. The due dates for the first 2 quarters of individual estimated tax payments were delayed to July 15th. The third and fourth quarters are due as usual, September 15th, 2020 and January 15th, 2021. As I mentioned, many taxpayers with losses for 2020 won't want to use the prior year safe harbor. Also keep in mind some states, including Iowa, did not follow the federal due date delays. And what happens if you fail to meet these estimated tax payment requirements? Basically, you incur non-deductible interest for the period of underpayment. The current underpayment rate is 3% for federal. It was 5% for the first 2 quarters. Planning tip for individuals: wage withholding is generally credited pro rata for the tax year, so increased withholding for the rest of the year may be able to reduce or eliminate underpayment penalties. Now, business loss planning is obviously going to be a huge issue for a lot of taxpayers. With the economy struggling, many businesses will be generating taxable losses for their owners. Taxpayers with business losses face 3 major hurdles to the deductions. First, basis. Taxpayers receiving losses via K-1 may only deduct business losses to the extent of their basis in the entity generating the loss. Then you have the at-risk rules. Taxpayers may only deduct losses to the extent their basis is at risk. Finally, passive loss rules. Individuals and trusts may generally only deduct passive losses to the extent of their so-called passive income. So if you're getting a K-1, how do you deal with basis limitations? The basis limitations are computed similarly, but not identically for S corporations or partnerships. So you need to know what kind of entity your K-1 is coming from. For S corporations, you start with your investment in the stock. Then you add direct loans that the shareholder has made to the corporation. You then add income items for the year, and then you subtract distributions, and then you subtract loss and expense in items. These computations are done in this order. If you want to deduct S corporation losses in 2020, you may find yourself limited if you take a lot of distributions in 2020. So if you've got distributions that you were thinking of taking, think twice if you're looking to take losses from that S corporation. Partnerships have a similar computation. You start with your investment in the partnership. Then you add your share of partnership debt. That includes direct loans you have made to the corporation, but it also includes any third-party debt incurred by the partnership, which gets allocated to the partner. Then you add income items, then you subtract distributions, then you subtract loss and expense items. So remember, distribution planning is a big part of loss planning for pass-throughs. Your next hurdle is the so-called at-risk rules. Non-recourse loans are not at risk, except with the exception of so-called qualified non-recourse third-party debt used to finance real estate activities. Loans from the entity, from another owner of the entity, or a party related to another owner of the entity are disqualified and are not treated as at-risk loans, even if they are, by their terms, full recourse debt. Losses that are not at risk are disallowed and carry forward until you have income. The third hurdle to deducting business losses are the so-called passive loss limits. Losses are passive if a taxpayer fails to materially participate in the loss activity during the year, and we'll get to what that means in a minute. Real estate losses are per se passive. That means they're automatically passive unless you are a qualifying real estate professional. Qualifying real estate professionals have to pass a tough hurdle, which we'll get to in a second. If they are a qualifying real estate professional, that doesn't mean their real estate losses are automatically deductible. That only means they get to test whether their losses are passive under the same material participation rules that apply to non-real estate rental activities. What are the material participation tests? For the most part, they're based on time spent on the activity. The test that generally applies to somebody who works full-time in a business is the 500 hours of material participation in a year. Another test applies to your serial entrepreneurs that have multiple activities. They materially participate in an activity if they participate in the activity for 100 to 500 hours, and when added to other such activities, the total participation in these activities exceeds 500 hours. Another test is that if a taxpayer participates 100 plus hours in an activity and more than anybody else. If a taxpayer's participation in the activity is substantially all of the participation in the activity, that should qualify. And then finally, you have the last ditch attempt to qualify as material participation. That's the regular, continuous, and substantial participation test under all facts and circumstances. It's best to qualify by the hours. Also, if you meet one of these other participation tests in 5 of the most recent 10 years, then you are considered to materially participate currently. Finally, retired farmers participate forever in the farming activity if they materially participate in the 5 years prior to starting to draw Social Security, retirement, or disability benefits. Not all participation counts. Participation has to be in operations rather than as an investor. An example comes out of a case where a taxpayer wanted to show that they spent more than 100 hours in an activity, but they were unable to document that their activity was qualified because a lot of their activity was investor activity rather than operating activity. Reviewing your investment, reviewing your records, reviewing monthly statements, those are investor activities. So you need to get your hands dirty somehow in the activity to have it count. Finally, documentation counts. Taxpayers who don't work full-time in an activity should maintain logs or calendars to show their activity if there might be any question. Tax court records are full of cases where taxpayers lost their deductions after going to the tax court with so-called guesstimates or using reconstructed time records to show their participation. Some of these reconstructed time records are great, or they show taxpayers working, in one example, 24 hours on Christmas, which shows real dedication to the business, but the taxpayer did not, or the tax court judge did not find that credible. Remember, if you want to say that you're materially participating in a real estate rental activity, you need to be a qualified real estate professional. That means you have to meet 2 tests. First, you have to show that you've spent at least 750 hours materially participating in a real estate activity in which you have an ownership interest. The other thing you have to show is that your real estate participation exceeds your participation in any other activity. That means if you have a full-time job where you work 2,000 hours, you have to show that you've also worked more than 2,000 hours in your real estate activity. And if you do, that means you get by with a lot less sleep than I do. Okay, one thing to remember now too is we are in the QBI Section 199A world. When doing your business income planning, remember that 199A provides a possible 20% deduction with respect to qualified business income. Proprietorships, S corporations, and partnerships generate QBI for use on individual and trust returns. C corporations are not eligible for this. Deduction is determined at the individual level, and the effect of it is to drop the individual marginal federal tax rate. If you're in the top bracket, your marginal tax rate falls from 29.6%, from 37% to 29%, 6.6%. QBI is subject to numerous limitations. For taxpayers with taxable income up to $163,300 for single filers, or $326,300 for joint filers, the full QBI deduction is available for otherwise non-qualifying business income. QBI over these amounts phase out over a $50,000 range for single filers or $100,000 for joint filers. So taxpayers who are having a good year might want to take enough deductions, if available, to knock their income down to get it underneath these phase out limits, if they otherwise would not be able to qualify for this under normal rules. And I should have mentioned the non-qualifying income includes things like consulting income, law practice income, accounting practice income, or income that does not generate W-2 wages to employees. And I could spend half of a day talking about QBI planning. That's just something to keep in mind. Okay, standard capital gain planning. Remember that for individuals and trusts, capital losses are only deductible to the extent of capital gains plus $3,000. Corporations can only deduct capital losses to the extent of capital gain income with potential carryback. Capital losses taken before year end can offset capital gains incurred any time during the year. Remember the wash sale rules that disallow losses to the extent an offsetting purchase of the lost security occurs within 30 days before or after the lost sale. For public securities, the trade date controls the timing of the loss. For short sales, the settlement date controls. Remember the mark-to-market rules for commodity transactions that mean that any gain that you have at year end in your account, even if it's unrealized, gets taxed in the year. Long-term capital gains are taxed at preferential rates for 2020. Single filers, these are your effective brackets for that. You'll notice that there's a large zero bracket for long-term capital gains, up to $80,000 for joint filers. A 3.8% net investment income tax also applies to taxpayers whose AGI exceeds $200,000 if you're a single filer, or $250,000 if you're a joint filer. Higher rates apply to so-called collectible gains like gold, coins, and so on, and certain real estate gains. So you might want to consider gain harvesting. Taxpayers with business losses may be able to take zero rate capital gains, depending on their income, up to, as long as their taxable income is under the $80,000 threshold for joint filers or $40,000 for single filers. Obviously, if you have a net operating loss, that would reduce the loss you can carry back, but that's just one more factor for your year-end planning. An overlooked gain planning opportunity is the zero bracket for other family members. If you have adult children, you make gift for them and their taxable income is such that they are still in the zero bracket, you can donate appreciated stock to them, and then they can take advantage of the zero bracket and sell it, and then possibly rebuy it with a basis step up if they still want to stay in the position. Well, there's a wash sale rule for losses. There is no wash sale rule for capital gains. And finally, I'm going to mention briefly opportunity zone deferral. This is something that is new with the 2017 Tax Cuts and Jobs Act. You can reinvest capital gains in qualified opportunity zone property and defer the capital gain for as long as as far out as December 31st, 2026. Obviously, you're gambling. That's a good idea. Also, if you hold that deferred gain property for at least 5 years, you can elect 10% reduction in the original deferred gain. And then if you hold the qualified opportunity zone investment for 10 years, then any additional appreciation can be permanently excluded from taxes. Okay, now we're going to talk about personal deductions and breaks. Tax Cuts and Jobs Act greatly increased the standard deduction. 2020 index amounts are on your slide. Combined with a $10,000 cap on itemized state and local taxes, this greatly reduces the population of Schedule A filers, especially for joint returns. What this means is this has provided or brought into play the idea of stacking deductions. In other words, taking 2 years of charitable deductions in 1 year and similar items so that you can get over the itemized deduction limit, or get over the standard deduction and get a better benefit for your itemized deduction. Remember that taxpayers can deduct qualified cash contributions in 2020 up to 100% of their adjusted gross income. This is a CARES Act change. Qualified contributions are to charities other than donor-advised funds and so-called supporting organizations. Also, appreciated property contributions to public charities remain deductible up to 30% of adjusted gross income. Corporate charitable contributions made during 2020 are limited to 25% of taxable income. The normal limit is 10% of taxable income. Remember that excess contributions carry forward for 5 years, then expire. Special rules apply to qualified conservation easement contributions. Watch out, there are a lot of traps in making qualified charitable contributions. Contributions of appreciated property held for 1 year are deductible at fair market value with the gain never taxed. That's a great opportunity. Remember that contributions $250 or more require an appropriate receipt from the charity, either listing the value of any goods or services provided by the charity or stating that there were none. No receipt, no deduction. And you can't get your deduction at audit time. Contributions of property other than traded securities over $5,000 require a qualified appraisal by an independent party. No exceptions to that rule. That's true even if the property gets sold the next day by the donee. You still need that appraisal. Sometimes you can sort contributed property into different categories to get each category under the $5,000 threshold. This can be a very useful thing if you're cleaning out the basement of a hoarder relative. These categories include things like stamp collections, coin collections, lithographs, paintings, etc. There could be other categories, but these are commonly seen categories. Note that china and crystal and silverware are all separate categories. Even though donor advised funds aren't qualified for the 100% 2020 special charitable cash deduction, they're still very useful as a stacking tool. Most people think in terms of their annual giving, and terms of annual commitments. Donor advised funds let you double up the charitable contribution deduction while getting to control the disbursements to charity out of the donor advised fund. Remember, home loan planning has changed since 2017. Maximum indebtedness for loans after 2017 for home acquisition is $750,000, and home equity loans don't qualify for itemized deductions right now at all. Okay, Now, we've got a lot of ground to cover here, and I want to have a couple minutes for questions, so we're going to cover the last parts quickly. One thing that's a standard tax planning thing is to use your tax planning tax advantage savings opportunities. Maximize your 401k, especially if your employer matches it. It's kind of silly to not take money from the boss. You then go to IRAs. If you're eligible because you have Schedule C or other self-employment income, consider the ability to use SEPs and other individual retirement plans. Health savings accounts are a great opportunity with no income limits for qualifying taxpayers. And then for taxpayers who have college savings needs or high school or elementary tuition now, Section 529 plans are great and may provide state deductions. And ABLE savings accounts are a great way to build up a nest egg for someone with disabilities. The 2020 retirement plan limits are listed on your slide there. We won't go through them in detail, but you can review those. If you have a taxpayer who has a lot of self-employment income but doesn't have employees, a solo K or a SEP might be a great opportunity. A solo K is actually a standard profit sharing cash or deferred arrangement for a business owner. Properly set up, it allows deferral of 100% of comp up to $19,500 or $26,000 for those 50 plus, and 25% of comp as a profit sharing contribution up to a total of $57,000. This is a bit larger deduction than a traditional SEP, which is limited to 25% of comp. SEP is a SEP IRA. The 401k is a traditional qualified plan with all the annual reporting requirements that applies. It needs to be set up before year end. Deferrals need to be made and deposited before year end, though the non-deferral proportion may be funded as late as the extended due date of the employer return. The SEP is a type of IRA, meaning minimal annual reporting. That can be set up as funded as late as the extended due date of the employer return. So sometimes it's a great mulligan when you're preparing a return. Savers credit, a widely underused credit. This is also something that encourages gifts by parents to children who might qualify, who are in the phase out, whose income is in the phase out range. They can provide cash for the child to fund an IRA, and the child might also get a tax credit out of the deal. Health savings accounts are like IRAs, except better in that there's no income limits for the deductions. If you qualify, withdrawals for unreimbursed health expenses are tax-free. They can be used like IRAs after the taxpayer achieves Medicare eligibility. And contribution limits are on your slide. 529 plans, I think most people are aware of. Reminder, estate and gift planning is huge this year. The 2020 annual gift exclusion is $15,000, but more importantly, the lifetime per individual exclusion is $11,580,000 for 2020 gifts and deaths. That means a couple can do $23 million of gifting and not pay any estate or gift tax. Why is that important? Well, you may have noticed we have an election coming up. A major shift in political control is possible, and that can mean a lot for tax planning. Individual income rates and investment income rates could increase. That could mean that the usual idea of deferring income to next year might turn out to be a bad idea. If your effective rate for business income goes from 29.6% to 39.6% or higher, then deferring that income could be a mistake. Also, both the Democratic platform is likely to include a significant reduction to the estate and gift lifetime exemption to at least $5 million, possibly to as little as $3.5 million. even if you are convinced that one side or the other is going to win, you ought to have a contingency plan, because really nobody knows. And if you're in a position where you might want to make significant gifts to use that big lifetime exclusion that's available right now, you might want to have something in place now rather than having to scramble in November to do your estate and gift planning. You want to be able to pull the trigger if that's going to be a live issue. And with that, I'll go do a quick parting note. Quote Abe Lincoln, who said in his House Divided speech, "If we could first know where we are and whither we are tending, we could then better judge what to do and how to do it." That's true in tax too. You really can't do tax planning unless you have a pretty good idea of what your taxable income is going to be, absent any further planning moves. You got to run the numbers, got to run projections. Time and fees spent on projection and planning can make a big difference. And to finish up, basically what I'm doing is answering questions. So
Perfect. Looks like we have one question here, and it says, if a client took an RMD in early 2020 but don't need the money, can they put it back in their account?
I believe the answer to that is yes.
Perfect.
Feel free to email me. My email address is on the slides. And thank you for your time. For those of you who were here last week, thanks for returning, and really appreciate it.
Awesome. Thank you all so much for attending. Thank you, Joe, for presenting. You guys have a great day.